Alright, hello everyone, and welcome to a video about Australia's current trade conditions for Unit 3, Area Study 3 for Economics Australia and the world economy. The main reason we're doing this is because in the last 12 months, it's kind of been weird in terms of how Australia's trade conditions have been going. The exchange rate's quite high, and even despite that, trade balance is still really good. The current account's in a surplus, which historically it's usually in deficit. So we'll talk about that. We'll talk about why the terms of trade is so high, and also what's happening with our net foreign debt. So we'll tie this in now pretty quickly with key knowledge that's important for this. So when we look at this in Unit 3, Area Study 3, it ties up with factors affecting the value of the exchange rate, including relative interest rates, demand for exports and imports, which is going to be a major part of what we talk about. Capital flows, a little bit less important at the moment. Terms of trade, we'll talk about why that's so high, and relative rates of inflation, kind of not too important at the moment. And then we're going to talk about the effect of these exchange rate movements on the current account balance. We're not really going to talk about too much about the domestic macroeconomic goals and living standards, but they might come up a little bit. And this is because some of your key skills are to explain patterns, trends, similarities, differences in economic data and other information, as well to access and interpret and draw conclusions from information gathered from a range of sources. So if you're only looking at a textbook or only looking at the PowerPoints that your teacher gives you, it's probably not giving you the wider scope of what's happening in the world that's leading these factors, which these factors are very much affected by each other and affected by what's happening all around the world in the pandemic and the recovery from the pandemic. And so it's very, very important that you have an idea of what is happening so you can get the best quality answer possible that shows you understand the economy. So we're going to get straight into the exchange rate. So at the moment, the exchange rate has appreciated in 2021 to about 77 US cents. As you can see on our graph here, which if you look at this on Trading Economics or any of the currency type places, you'd see that it's updating like second by second, but on average, we've had an appreciation of this exchange rate, and we're sitting around here at the moment. So that's around 77 US cents. This has happened due to significant demand for iron ore from China. So there's a lot in the news at the moment about China and Australia, and a lot of what's in the news has been about the trade barriers that China's been implementing for Australia. So things like tariffs, there's like an 80-something% tariff on barley and a 300% tariff on wine. There's been a big deal about that. There's also been things like limits and tariffs on the export of seafood from Australia to China, which is why lobster was so cheap around Christmas time in Australia. And all those trade barriers have been getting a lot of basically time in the press. But the important thing is that the impact of the demand of our iron ore has far outweighed these trade barriers. So the demand for iron ore has been so significant. So in China's recovery, basically what happened is the government put a lot of investment into infrastructure and expansion, and this created a lot of demand for steel production, and for steel production they need iron ore. Australia's got one of the largest supplies of iron ore, so they needed to demand it from us. Even though we are having trade issues with China at the moment, because they needed that, they still had to buy it from us, and this put a significant demand for our iron ore. This means for the exchange rate, to buy our iron ore, the Chinese have to convert their currency to Australian dollars. This takes Australian dollars off the foreign exchange market and puts upward pressure on the Australian exchange rate, and therefore it has been appreciating over time, and we've led to the exchange rate that we have now. Normally an appreciated exchange rate would be seen as a bad thing. Historically, they've wanted us to have an exchange rate of around 60 US cents to be as competitive as possible, because that makes our exports quite favorable and makes us not want to import things. However, at the moment, because of the significant demand for our iron ore, the higher exchange rate hasn't been having that much of a negative effect for Australia. So then to move on to our terms of trade, because of this, as you know, with the terms of trade, it is an average, well, the average prices received for exports over the average prices paid for imports. At the moment, the terms of trade has increased to the highest I've ever seen it, which is 115 index points. This is due to that significant demand for iron ore exports, which has put upward pressure on those export prices compared to import prices. Remembering that this is relative, so with that increase in the exchange rate too, with that increased AUD, it makes our exports more expensive and lowers the price of imports. So already in terms of those indexes, when we look at the terms of trade, and we've got the export price index over, I don't know why I put an X there, over the import price index, that ratio is going to change because of that. It's going to be favorable that both export prices are increasing and import prices are decreasing on average. So this means that on average, we receive more for our exports relative to what we are paying for imports. Another favorable thing for that is that import prices on average are falling, that can lower cost of production for businesses on the aggregate supply side, which is also a very, very favorable thing. So at the moment, that means that we are receiving more for exports, which is great. In terms of trade being an aggregate demand side factor, that means we're getting more injections into the economy and less injections, less leakages coming out of the economy. This favorable for aggregate demand means aggregate demand should be increasing overall. And so that's what's happening with the terms of trade. And it's because of that demand for our iron ore exports driving up average export prices. Then with our current account, to look at our current account at the moment, the really important thing to look at is, well, one of the facts is that it's in surplus, but also looking at the balance of trade, because the balance of trade is one of the main reasons why our current account is in surplus. So as you can see, for the last year and a half, really, if we're looking at here, or really it's a year that we're looking at, it's been in surplus the whole time. So that means exports have been greater than imports, which is something that Australia has had a trade surplus a lot throughout history. We're one of the only countries that has a positive trade relationship with China, which is ironic at the moment, but it means that we get more credits coming in for our exports rather than debits leaving for our imports. So this has led, one of the reasons why it's led for our current account to be in surplus. As you can see, it's gone from a deficit in 2018 up to a surplus all through 2019 and 2020. This is also partly due to record low interest rates. So one of the main reasons that historically our current account has been in deficit is because of our $1 trillion of net foreign debt, and interest must be repaid on that. Interest for net foreign debt is repaid in the net primary income section of the current account, and this usually means that significant debits are going out through interest repayments to overseas countries to pay that interest on our foreign debt. Because interest rates have gone so low all throughout the world, it has lowered the interest burden on this debt. And this has then meant that we have had a lowered kind of debits going out of that net primary income section while also having a positive balance of trade, and therefore the current account ends up being in surplus. It's going to be really important because if you look at the study design, at the moment it says reasons for our current account deficit, which we're not in, but historically we have been. And I have a feeling that VCAL will ask a question like, it will just say current account, and the students who have only looked at their textbook will start talking about a current account deficit, which we're not currently in, whereas the stronger students will talk about the actual current account that we have, what's current, and the fact that we are in a surplus. So that's very, very important there, and it's mainly because of our trade balance and that reduced interest burden in our net primary incomes, meaning less debits are going out. Then lastly, we're going to talk about our net foreign debt. So if we look at our net foreign debt, it is this orange line here. This orange line comes out over here. We are just under $1.2 trillion of net foreign debt, which is a fairly significant amount. It's a mix of public and private debt. Our public debt is getting to almost $1 trillion, which is basically the debt of the government through budget deficits, etc. It will probably get there in the near future because we're expected to be in deficit for the next 10 years. Still, this massive net foreign debt, trillions of dollars, terrifying to look at if you just looked at it in pure money form, but still currently seen as a positive as the debt is being used to invest in the Australian economy. So as long as this debt is being used to increase our GDP or our production, our economic growth, increase employment, etc., that is seen as a positive. What sometimes happens, and when we get into looking at Unit 4 budgetary policy, sometimes being in deficits continually over time and increasing our net foreign debt, the main worry is this creates an interest burden for future generations and may negatively impact their living standards. So the main worry from that is that in future generations may not be able to invest in their economy as much, because if interest rates go up, they're going to be spending more government revenue on repaying those interest and repaying those loans that we've created now. But the general idea being that if we invest in the economy now, the whole point of an investment is to get more return than what you've put in. And if our investments in the economy through this borrowing are positive, we're going to be more than able to pay it off in future. So that's the main thing with net foreign debt. Obviously, the higher net foreign debt is, the more we're going to have debits in net primary incomes going out as those interest repayments. But at the moment, while interest rates are low, this net foreign debt isn't too much of a worry. So that's pretty much it for current trade factors in the economy. I hope this has been helpful to you. If you have any questions at all, feel free to leave a comment below. I also wrote this kind of in blog form at my website there, therunningeconomy.com. Feel free to check that out. Talks about it in more detail in text form. Thank you for watching my oddly specific presentation about the Australian dollar and other factors in Area Study 3 of economics. If you need any other help with anything at all, as I said before, on my website, there is a Discord link on that website. Obviously, there are many other videos on this YouTube page. In this playlist, there is a couple looking at past exam questions from BCAR. If there's anything specific that you think would be helpful to you, let me know as well. Other than that, I hope you have a wonderful day. Enjoy your next 7 days of lockdown, and I'll see you next time. Goodbye.